Price index up 0.2% from the month before compared to a year ago. Consumer prices 2.9%. Joining us right now is Kingsview Asset Management Chief Investment Officer Scott Martin. Scott, good to see you. Thanks so much for joining us.
Hey, Maria, how you guys doing?
Year over year, you got the actual number below the estimate, which is 2.9% versus an estimate of 3%. Your reaction to the CPI just hitting?
Yeah, to quote one of my favorite all-time bands, to Led Zeppelin, the song kind of remains the same here. You know, the economy continues to grow and I think continues to improve. But as you guys have talked at the top of the hour, especially, you know, inflation still remains to be seen. And I think that's really a good thing from the standpoint, Maria, that this market, as far as stocks, have loved the easy money from the Fed. They've loved the low interest rate environment. I still remain to think that this is a Fed that are doves in hawks' clothing, meaning that they will be dovish if they need to be, hawkish maybe if inflation data ticks up. But the Fed's in a pretty good sweet spot here where they can kick a couple more interest rate hikes in here, but they don't have to be overly worried about inflation in 2019.
Scott, one of the fascinating aspects is that when inflation comes back, one of the best places to park your cash is in real estate in rising interest rate environments, too, because inflation's going up, right? They're raising rates because of that. We've seen the retailers do well last quarter. They're going to be issuing earnings next week. We've seen retail real estate up 15%. Walmart's going to be issuing earnings on Thursday next week. Macy's on Wednesday. Home Depot Tuesday. How are you positioning yourself in the markets given the dynamic where the consumer's stronger? We're starting to see inflation pick up. Jobs are doing well. I know you have a model on jobs for investing. So can you tell us where you're putting your money?
Yeah, you're a good man. You follow the models like I do. And I'll tell you, Kevin, you know, we talk about real assets in a rising interest rate environment, a somewhat, let's say, bubbling inflationary environment, but one that's not going to go crazy. So we do like retail here. We've seen retail bounce back considerably in the last several months. As you mentioned, the consumer has strengthened, and there's been some, let's say, wage growth, even though it's been a little bit scarce. I will tell you this, though, especially looking at the jobs numbers, you know, we still are very encouraged by what we're seeing. It's not overly impressive, but it's in this little sweet spot where the Fed can continue to do their work. The economy looks like it's set to grow here, maybe at about 4% this quarter. I think we'll finally get one in Q3, a 4% number. So to us, this is a really nice spot for those who want to get back into retail, especially given their strength and given some of the numbers we've seen on the consumers.
One thing, Scott, it's Dagan McDowell. As you move throughout the summer, you will likely see those energy costs come down. The overall inflation number may be even a little more tame than we've seen. But as Kevin pointed out earlier, big picture, real incomes are growing, meaning that incomes in this country are still growing faster than the overall rate of inflation. Like if you look at just your core rate here, up 2.4%, the PCE, which we got, I think it was last week, is up 2.2% in the last 12 months. So again, people earning more money than consumer prices are going up.
Yeah, totally, Dagan. You know, look at the GDP deflator, too, that suggests a similar analysis. And I think, as you guys astutely pointed out some minutes ago, you know, there's a weird spot kind of going on with inflation data. It's raw material costs, which are going up, which could possibly be maybe just transitory because of the tariff-related stuff. But then there's services inflation, which is really nowhere to be found. So the consumer is getting a little bit of a benefit there. Companies maybe not so, but you're not seeing companies pass on those increased costs yet. And that's a questionable scenario, because does that mean that companies don't feel like those are here to stay, so therefore they don't need to pass those on? Or do they not have the pricing power to do so? Obviously, as I hate to say, as kind of a recovering economist, let's say, time will tell us as to what the story pans out there. But so far, that's been an okay scenario and something that stocks have been able to digest.
Today, we've seen actually kind of turmoil happening over in Turkey. And so I'm not seeing really a move come out of the markets. I mean, if we look pre-market, 0.5%, that's nothing. So what are your concerns for the second half of this year? You know, I mean, it seems to be a very, you know, bullish time to be putting new money to work. But what should we conceptually be thinking about going into the latter half of this year?
Yeah, I agree, Kevin. I'll tell you, I think this is one of those Italy scenarios that we saw a couple months ago when there was some concern about Italian debt spreading throughout the financial system. You saw a drawdown that was meager, maybe 3-4%, depending on your favorite index. A tremendous buying opportunity, like many of the drawdowns have been in the market in the last couple of years. I think this is something similar if it does bleed out for a matter of days. So as an investor, if you have cash on the sidelines, definitely look towards some opportunity there. But I'll tell you, going forward, there's two issues. One is the Fed and just what they're going to do with some of the data that's coming out, just to make sure that kids, the data doesn't come out too hot. Because I will tell you that if that does propel the Fed to follow through on some of the promises that they've made for interest rate hikes, say in 2019, I think higher interest rates for this market, certainly for the consumer, could be the worst thing to happen to them since, say, Paris Hilton came out with her debut music album, which was really terrible. But also, I will tell you this, also just in the meantime,
Right.
how about midterm elections, guys?
Yeah.
Midterm elections are definitely up in the air, especially as the House goes, if they vote to impeach Trump.
So you think the House flips?
I do, Maria, and they're going to push forward this impeachment vote if they do get the House.
Right.
Obviously, it's not that big of a concern because of the Senate situation, but that, again, is just some uncertainty, just some headlines that the market could take negatively in the meantime.
Yeah, Heather.
Well, I'm the contrarian because I don't think the House is going to flip. I don't know that it'll be a red wave, but I do believe that they're going to hold on to the House, and we won't have to have Maxine Waters as heading financial services. But with Erdogan, you know, that's a very good lesson on the value of having countries have their own currencies, not be stuck with something like the euro. If currencies actually reflect underlying value, he's done things that it's going to take his country a long time to recover from, but at least it's contained in what happens within their country. It doesn't, I don't believe, become systemic. With the Fed, which you called doves in hawks' clothing, don't you in fact think, though, that it is a good thing that we've moved away from quantitative easing, which was a policy that essentially was very good for people who are already doing quite well, but it really hurt the middle class, and it taught a whole generation of people that there was no point in saving anything. So moving away from that, to me, strikes me as actually a very healthy economic move.